Hi students, you are welcome to the class on AEA 308, the principle of farm management, lesson 7. The topic of our discussion will be on benefits and costs of agricultural projects and financial statement. I believe you all enjoy lesson 6. Lesson 7 will be an interesting one. Stay put and listen. I am Dr. Helen Inyang, your course facilitator. Thank you. Again, the topic of our discussion today is on benefit cost analysis of agricultural projects and financial statement. This lesson is devoted to discussing benefits and cost analysis of our agricultural enterprises. The lesson will further classify cost and benefit into tangible or primary, that is direct, and intangible or secondary, indirect. This lesson will also identify the various costs and benefits of agricultural projects. This lesson will treat the meaning of assets and liability, how we can prepare a balance sheet account and profit and loss account. From the statement of benefits sheets or balance sheets, we will calculate the net worth and financial ratios. So the financial ratio will be calculated from balance sheet accounts included net capital ratio, working capital ratio, and current ratio. The objectives of this lesson is, by the end of this lesson, you should be able to identify benefits in agricultural projects, identify costs in any farm enterprises, define benefits in agricultural projects, define costs in agricultural projects, define or classify the various items and operations in agricultural activities into benefit and cost, define assets and liability, prepare balance sheet for commercial farm, calculate net worth for balance sheet, and then prepare profit and loss accounts for commercial farm. As well as the cost of goods and services, cost of land. Proper value to place on land in an agricultural project is often complicated subjects because land markets are not profitable, are not perfect. Yes, land markets are not perfect. So three alternatives are used to value the land in economic analysis of the project. One is the value the land at its purchase price. How much is the present purchase price of the land, or the purchase price, how much the land was bought. Then value the land at the rental cost too. That's in case you want to rent it out. Then value the land at an estimate of net value of production forgone as opportunity cost of returns each year. So those are the three methods that we use to value land in economic analysis. So the next cost here is taxes. Taxes are transfer payments which require special treatment in project analysis. These are payments for projects to the whole society. Then we have the last one, the fifth one here is the subsidies. Subsidies are transfer payments to the project or to the farmers in a project from the rest of the society. A subsidy on fertilizer reduces its cost to the farmers and thereby increase his income. So when we are talking about subsidy, it's just maybe the government or whoever concerned subsidize, paid part of the money, the actual amount. Taking for example, if the fertilizer is worth is worth 5,000 in the market, then the government may decide to subsidize the fertilizer by 50%. That is, you pay 2,500. So the farmer now, instead of buying the fertilizer at the cost of 5,000 naira, will end up going home with fertilizer at the cost of 2,500 naira. So the subsidy of that 50% is from the government. That is a 50% discount now. Given is the government that paid that. So in economics analysis, if subsidies subsidize operates to reduce input costs, then we must add the subsidy to the market price of the commodity. So even when the government might subsidize it, so it is expected for you to use it. And so when you are calculating your input cost of fertilizer is 5,000, not 2,500 because that is the original amount sold in the market. So you must calculate. Looking at cost reduction, B, that is cost reduction. In addition to increase in the value of outputs, benefit in agricultural projects may be from a reduction in cost. Example, we have gains from farm mechanization. Reduction in the cost of production through mechanization may increase benefit. Total Total production may not increase provided that any labor display can be productively employed elsewhere. And you can see that when you are using mechanization, that the work of that 10 people supposed to do maybe for a week can be done by just one person handling machine with using one day. You can see that the gain has been there. The money that's supposed to be used to pay for 10 people for 1 week has now been reduced to pay for just one person and then demand there. So you can see that there is gain in reduction through mechanization. That is cost reduction. That is the benefit also as a result of cost reduction through mechanization. Reduced transportation costs. As better transportation may reduce the cost of moving produce from the farm to the consumers. Such benefits are very common in agricultural marketing, especially where there is good road networks and there's good commercial vehicles. The cost of transportation will also be reduced. Then we also have this third one, losses avoided. One kind of loss reduction benefit may arise because of loss avoided. So example of such benefits are storage projects. Once there is a storage facility, then it will reduce the rate of loss in agricultural produce. Also irrigation system. With the help of irrigation system, drought will not cause an hazard or will not hamper the growth of the crops, as well as hindering the or reduction in the yield. So maintenance and soil conservation through prevention of water losses and soil erosion too will also help in benefits of to the farmers. Then other kinds of direct benefits. Such benefits may come as a result of increased saving capacity of individuals, improved education, and training. Then also better health working conditions. Those are the benefits too, direct benefits. Then we also have land should also be valued at the purchase price. That is also cost. Infrastructures use in the cost of production as well as credit use. All these things are costs of crop production. Then let's also cost of livestock production. Cost of livestock production. Animal husbandry is another important part on many farm budgets in Nigeria, where farm animals exceed a pair of bullocks for drought power. Then the cost of animal husbandry sector is to be developed. So one, we also consider this cost incurred. So we have A is land for field to grow further and also for fence building. And two, labor costs for maintenance and production of livestock. Three, veterinary services and supplies. Four, that is concentrate, minerals and salt. All those things constitute a cost in livestock production. Let's look at cost of project costs. It is important that all project costs are identified and accurately accounted for. We have A here is a capital cost. All capital costs of a project works are to be listed by items, quantity and units cost. Some of the capital costs include replacement costs. That is, includes the replacement cost, electrification cost, transferring transfer payments such as interest on investment, custom duties, sales tax, etc. All these are costs of projects. Then the fourth one is subsidies. We all know about subsidies. And then discount of a percentage, maybe the government paid percentage, like I made mention of using fertilizer as an example. Then another one cost is contingencies. This contingency is equal to 15 to 20% of the capital cost. Land acquisition too is a cost, which is the actual cost of the land. Then B is operational and maintenance cost. Those are the different types of costs we should know in the course of farm management, agricultural production. These items generally include the following: personal costs. It should include all management and labor costs. That's personal cost. Equipment and supply to run the project is also a cost under operational cost. The cost of energy under operational, that's electrification and so on. Then cost of buying gas, oil, diesel, etc. to run the vehicle and machineries. So let us also consider the benefits, the difference of the benefits, primary and tangible benefits. We have agricultural production should be estimated for each of the two conditions, that is without projects and with projects. So we look at them. Then an analysis period of 25 years is ample for determining the economic worth of an agricultural project. Its benefits. Then gross value of production. Gross value of production (GVP) should be determined on basis of farm gate prices multiplied by total production year by year for the project analysis period. Then we have here net value of production. The net value of production is the gross value of production less the cost of production other than the cost of project itself. So the secondary and intangible benefits. So apart from the additional employment created for farm production, there will be many secondary benefits and intangible benefits, and that should be enlisted or ruminated events through, though are not quantified and their values are not included in analysis. So normally, like we said before earlier on, when you are calculating all these benefits, of course, it is only the primary benefits that are always calculated empirically. So the secondary benefits and costs cannot be estimated because there are in qualitative terms. So financial statement. Meaning of assets, we have to look at assets and liability. What is an asset? An asset is anything of value possessed by the business or any claim to the value on possession to others. That is an asset. And in agricultural farms, assets refer to all materials, that is goods and services owned by the farmer and used in the production processes. That is an asset. Assets could be classified into the following. We have the fixed asset, working asset, and current assets. Then liability. Liability is a accounting means that is liability in accounting means any claims which people outside business have against the business. In farm business, liability refers to goods and services which the farm owns to others. So liability are usually classified into two or three. We have the long-term liability, medium-term liability, short-term liability, or current liability. So let us consider the balance sheet here. The best possible measure of capital position of a farm at any given time is shown by yearly balance sheet. So shown by yearly balance sheet, we have the balance sheet showing the asset and liability of a farm business at the specific point in time, usually the last day of our financial year. So to illustrate balance sheet or net worth statement account of considered the farm business of J. Ibotu Farm Limited for a year ending maybe May, May 2007. So let's look at it. So this is the balance sheet for year ending of Ibotu Farm at 31st May. So we have looking at this, the left side here is liability and the right hand side is assets. So looking at this now, you have the current liability in Naira and the current assets in Naira. So let's consider the side of liability first. We have here the debt due to for payment 500 Naira under current liability. Then under medium term liability, we have debt due for payment in about 2 years, 12,900 Naira. Then looking at the long-term liability, we have mortgages 5,300 Naira, debts for payment in long term, 19,900 Naira. So if you sum this up, you have a total liability of 38,600 Naira. And then let us also consider the assets of site. The current assets in Naira, we have cash in hand, 500 Naira. Stock for sale, 1,400 Naira. Accounts receivable, 1,100 Naira. Then working assets. We have in working assets, feed in stock, 500 Naira. Supplies, 200 Naira. Harvested crops, 9,200 Naira. Then also under the fixed asset here, we have under the fixed asset, we have buildings 13,000 Naira. Machineries and equipment 15,000 Naira. Land with crops 3,000 Naira. Dairy cow and breeding stock 15,000 Naira. So total asset here is 58,900 Naira. We can use this asset and liability to calculate our net worth. So net worth, our net worth is equal to total assets minus total liability. That is 58,900 Naira minus, as seen here in the left hand side, 58,900 Naira minus 38,600 Naira. We now have a sum of 20,300 Naira as our net worth. So, in real terms, net worth or net capital is the amount by which total value of asset exceed the total value of liability within a period of time. Like that is what we calculated so far. This implies that net worth value is calculated from the balance sheet account. Yes, in farm business, net worth or net capital is used to determine the overall performance of a farm at a given period of time. Then we also have a net capital. Oh, Messi. Oh, you can't handle. Oh, well, oh, be nam dear. Sorry, sorry, sorry. What? So, as I was saying, net capital show how much the business worth if it has to be sold at that point in time. So it is the best possible measure of farmers' financial position and its growth. And its growth is a direct measure of growth of business. It shows that at a glance whether or not the farmer is credit worthy. Net worth statement is only very useful when compared to the past values. The previous values will show whether the farm business is progressing or not. So calculation of net worth from example 1 here gives us the example we have just carried out. So the total assets is equal to 58,600 naira. The total liability gives us 38,600 naira. So the worth total assets, the net worth is equal to total asset minus liability. We have already calculated this, which gives us the sum of 20,000 naira, 20,300 naira. Then let's also look at the accounting ratios, how to go ahead calculating them. The accounting ratios. Let us see how we'll be able to calculate the accounting ratios. So how to calculate the accounting ratios that can be obtained from the statement of balance sheet includes net capital ratio, working capital ratio, current capital ratio. So let's look at the net worth ratio or net capital ratio. So the net capital ratio is measure of degree of safety for the entire business. It is a ratio of total assets to liability. The greater the figure above 1, the safer the farm business financially. So let's see it still using the above example. let's calculate our net capital ratio. So total and net capital ratio, NCR, is equal to total assets all over total liability. So from the example we had, the example one we had there over, so total asset is equal to 58,900 naira, while total liability is equal to 38,600 naira. So you now divide 38,000, sorry, you now divide 58,900 naira by 38,600. Now we have 1.53 as the net capital ratio. So this figure 1.53, when expressed in a ratio, is about 1.5, which means that the assets are about 1.5 times the value of liability. So there is no acceptable level of financial safety. So it is left to individual farmers to determine the safety for his farm, because a particular individual farmer will say, okay, I am okay with this, but another one will say, it's supposed to be more than one, or it should be about 3 or more. So B is the working capital ratio. So this is a working capital ratio. This is also known as immediate ratio. That working capital ratio measures the degree of financial safety of the farmer over an immediate period of time. That's about 1 to 3 years. Capital ratio, that is, measures the ability of the farm to meet current financial obligations. It means it measures the degree of solvency of farm businesses. Mathematically, current capital ratio assets. That's current capital ratio is equal to current assets all over current liability. We are still using the same example. Then current asset is equal to 3,000, while current liability is equal to 500 naira. So now you have current capital ratio will be 3,000 all over 500 now, which gives us 6. So the current capital ratio here is 6:1, which means that the farm can meet its current financial obligation 6 times over. This figure can be compared with a previous figure for better judgment about the performance of the farm. The profit and loss account. The ultimate goal of any business is to make profits. So one of the best way of assessing how well the business is progressing is by preparing a profit and loss account for the business. So there are 3 essential components of profit and loss account. We have one here is a total products on returns. So this recorded as income or receipts or credits in the profit and loss account. It is the income obtained from sales and other sources together with valuation on hand at the end of the accounting period. So some of the essential items used or under this component include closing valuation of output resources, income during the year, debtors at the end of the year. Then B is the total expenditure. We are talking about how to calculate the profit and loss account. We have total expenditure. This is recorded as purchases or expenses or debts in a profit and loss account. It is the sum of the expenditure items and valuation of the input resources at the beginning of the accounting period. So some of the essential items under this component include opening of valuation, resources, expenses during the year. Let us see the C1, the C part, profit or net farm income. So net farm income is the amount by which the value of total products produced in the accounting period exceeds the value of total resources used during the same period. That is, profit is equal to total value of products minus total expenses. It is regarded as a profit if the total value of products is more than the total expenses. It is, however, regarded as a loss also if the total expenses are more than the total value of that product. So as such, profit is recorded under debts while losses is recorded under income. In conclusion, we have learned about the benefit cost analysis of agricultural projects. In our discussion, we have also been able to differentiate costs from business in agricultural projects. We have further classified costs and benefit into tangible and intangible. We equally identified all the various costs and benefits of agricultural projects. We have learned the meaning of assets and liability. We have also illustrated how we can prepare a balance sheet account from the statement of balance sheet. We can also calculate the net worth and financial ratios. The financial ratios calculated from balance sheet accounts include net capital ratio, working capital ratio, and current capital ratio. We finally illustrate how we can prepare a profit and loss account. We have learned in this lesson we have learned that is a summary. We have learned that business means any gain in goods, materials, and services. Cost means expenditure of goods or expenditure of goods, material, and services. Tangible or intangible benefit or cost carries no monetary values. We know that is a secondary benefit or cost. Then tangible or primary benefit or cost can be expressed in monetary terms. Primary benefit are the value of goods and services which emanates from the project. The added value over and above the value of goods and services which emanated from projects are called secondary benefits. Value of materials and services used for undertaking the project are called primary costs. So secondary costs are costs incurred when securing secondary benefits. Farm assets are goods and services owned by the farmer and used in production processes. Farm liability are goods and services which the farmer owns to others. Farm assets are classified into three: current, working, and fixed assets. Farm liability are classified also into three: current, medium, and long-term liability. Balance sheet statement contains assets and liability of the business at a specific point in time. Profit and loss accounts contain income and expenses statement of business over a given period of time.